All right, welcome back, guys. Got a very, very special guest today. We have Travis Spencer from Real Estate Mindset. Was kind enough to hop on the channel and join me. We're going to pick his brain on some of the activity going on nationwide and some of his thoughts. Travis, want to first say thank you so much for being here. And for anyone who may not know, which is probably no one, can you just give us a little background about yourself and tell us who you are?
Yeah, so right now I'm spending a lot of time on YouTube. So I'm a YouTube influencer. The name of my YouTube channel is Real Estate Mindset. I've also spent time on creating a free, I wanted to be like the only guy in the world that put his heart and soul in a home buying course, but offered it to the community for free to learn about like bare essentials when it comes to buying, because it's exactly what we need right now in such a toxic market. In fact, there's never been a more important time in the housing market, Ben, to have fundamentals when purchasing. So I've done all of that. But as far as like my history in real estate, I've been licensed and a loan officer for about 22 years. I've been a licensed realtor for about, I think, 10 or 11 years now. But the thing that I love doing the most, man, I make a lot less money doing it, is I'm also a certified instructor and a certified provider, which is basically a real estate school. So I'm a real
Mm.
estate school. I love teaching people. I'm a cheerleader. I cheerlead their cheerleader. So I'm constantly I've stepped down recently, but I'm constantly trying to train realtors, and I'm constantly out there saying, you guys stop the cheerleading, stop the nonsense, just use the data. Like just
Mm.
explain to people what is wedge, right? What is the equity, right? What is cash flow? Like teach people how to buy smart. Don't
Mhm.
just sell a narrative. Sell the data. Talk about the data. Don't just talk about what you see in mainstream, because it's bad right now, man. And I would say overall, I'm trying to help people prevent what I went through, Ben, which was during the great financial crisis, the GFC. I lost everything. And I
Mm.
was this prodigy loan officer. I was so good at my job, but I had my foreclosure, bankruptcy, a repo. As a result of the deficiency notice from the foreclosure, I could not file insolvency. So I was issued, on top of my credit being destroyed, a tax lien for over $100,000. And I lost my job, so I couldn't pay that. That thing followed me around for 9 years because the statute of limitations was extended because of the bankruptcy. So I don't know how I survived. I mean, I was at the worst stage of my life with the hardest ability to get credit and to get back up. So
Yeah.
once you're down, man, they keep you down. And I just want to be the guy that provides a different perspective. It's definitely more bearish. I definitely think we should keep our eyes on data. We should be patient. Obviously, they're still doing quantitative tightening. A lot of people are suspecting the lag effects are still ongoing, which makes sense because of the massive money printing. But overall, man, I'm just gonna say I'm just a normal guy trying to figure it all out, man.
Nice, Travis. Yeah, and that's what I respect about you, bud. He's just out there trying to give everybody the information, help people out, and just straight shooter. And that's what we like around here on this channel. So, without further ado, thanks again, Travis. Going to jump right into it. Wanted to get your thoughts on the emergency loan program that they have announced is going to end on March 11th, because a lot of people actually don't even know that this was in place. This was a program they had put in to kind of protect the banks that were going under and give discounted rates to others. So, can you elaborate on that and what you're, do you see that affecting the markets once that ends on March 11th?
All right, so just I'm not an economist, right?
Yeah.
I'm a licensed realtor, but I've asked myself, 'cause I thought we were going to continue deflation going into 2023. That didn't happen on a nationwide average. So I asked myself, why? Why didn't that happen? Now, I want to first tell your viewers that we actually were experiencing massive price decline on a nationwide average for existing, I'm not even talking about new construction, existing homes going into 2023. We had a deflationary cycle that started. However, unfortunately, in March, with the bank failure, Silicon Valley Bank, they bailed out the banks. They bailed out the banks March of 2023. I believe on March 11th is when they made the bank term funding program. So I saw personally, watching all of the data, the moment that they did that, not only did they give a lifeline to most banks that are in distress, preventing a bust, preventing a credit phenomenon from happening. Um, so not only did they do that, they also changed the sentiment in the markets,
Mm.
because they didn't break the Fed put. What the Fed put is, Ben, is the Fed put is basically the market's interpretation that the Federal Reserve is going to bail out anything that breaks in the economy.
Mm.
So they're just going to keep bailing out. Oh, something breaks, they're just going to keep bailing out, but that's at our cost. The inflation's sky high. I mean, who can they bail out without inflation skyrocketing? So instead of letting the finance sector, which we needed, in my opinion, bust, they made that bank term funding program. and allowed banks to take their non-performing assets and exchange them at market value or at par for a slight fee of only 10 basis points. And what this means is, and what was happening is a lot of these banks purchased treasuries, the long end of the yield, long end treasuries like 10 years, 15 years, 20 years, 30-year treasuries. Now, the rates on those treasuries were super low, like 1, 2, 3%, right? So when the interest rates went up on these treasuries to 5%, those treasuries that they have to hold on to were no longer worth anything. They were no longer worth its value if they had to sell them right away. And the thing is if they would have been able to hold those maturities, like Silicon Valley Bank would have been could hold on to those maturities for 15 years, they would have been fine. But what happened is the cat got out of the bag. People were like, whoa, you don't have our money, so we want all our money right now. So there was this bank run on the Silicon Valley bank run, meaning all these people wanted their money. And they're like, well, hold up, we don't have your money. Your money is wrapped up in long-term treasuries. So in order for the bank to get their money back, they had to sell all those treasuries at a massive loss. And so that would have created a contagion. That would have created fear. That would have created the bust cycle, a continuation of deflation. But instead of letting that play out like they did during the GFC, it took them almost 2 years to bail out banks during the GFC. They met over the weekend, made this bank term funding program, and allowed banks that needed the money to trade in the non-performing assets for market value on today's assets. In essence, what I'm saying is at our expense, Ben, they allowed banks to not go under. They put a lifeline up under these banks that we didn't have during the GFC. And what that did in turn, again, it changed the sentiment. People are, everything's okay. But the biggest problem of all is it prevented lending restrictions. And that, my friend, was one of the biggest problems with that bank term funding program. There's very little lending restrictions. You see lending restrictions in commercial real estate. You see lending restrictions on vehicle loans, specifically subprime. But as far as mortgages, FHA, VA, USDA, conventional, you don't really see lending restrictions. In fact, in certain situations, Ben, they got looser. For example, FHA got looser because they lowered their mortgage insurance premium. And then remember the whole LLPAs, if you have high credit, you get penalized. If you have low credit, you get rewarded. So you got these politicians, you got these policymakers that are like, oh, we're going to help the first time home buyer. But yet they just bailed out all of the elites. You know, Oprah's money was there, Roku's money, the California governor's money. That's who they bailed out. They didn't bail out us. They bailed out them, my friend. And honestly, as a result, man, I mean, it's like the wild, wild west. They don't care the risk. They're not. Why would you be concerned about risk when you could just trade your assets in to this program? And so when it is gone in March, the thing is, man, I think it will have an effect. Okay. But we also have the reverse repo market liquidity out there. We need that to drain as well. But I'm also afraid that like the damage is already done from the bank term funding program, and the banks that were naturally going to collapse and naturally going to bust, they just got saved. So I don't know that ending alone is going to cause major economic turmoil. I don't necessarily think so, but I would say a combination of things like that program ending is going to put a lot more pressure on these bankers to start investing wisely. And then also what we have on top of that, Ben, and a lot of people are like, no, Jerome Powell, the Federal Reserve Chairman, did the right thing by bailing these people out. And I'm just like, okay, whatever. I don't think so. Like the guy freaking screwed us. But by doing that, he's also putting additional regulations on how much money the banks must hold. I think it's about 20% is what they're shooting for. So hopefully there are going to be some big impacts, man. But I think that we would have had our crash had it not been for that program. But I don't think that just because that program is ending, that is to automatically create a deflationary cycle again. I think that there's many factors that are going to do that. I think that it will put more pressure on prices to go down when you remove that lifeline out of the banking sector. And again, like you said, that ends in March of this year.
Yeah, that's crazy to just see basically backdoor bailouts again. Here we are, everything's so great, the economy's ripping, but this is what's going on behind the scenes. And you're absolutely right. I saw the exact same thing here, right around that time frame, January to basically December to March here. We saw an immediate price drop in houses that subsequently recovered through the spring. Now, Was that the only reason? I can't say with certainty, but that is pretty much what happened. The trend had started here and boom, rebounded. We're kind of heading back that way now. But it's very interesting. I did hear a theory that somebody threw by me that because that's happening, then the Fed is definitely going to start cutting rates in March, which I think is after the past couple of days is pretty much out of reach. But do you see that on the table at all, in your opinion? Any rate
Okay.
cuts in March or May?
Now, remember, I'm just a normal guy that's been through a whole bunch of crap.
Oh
So
yeah.
I don't know 100%, but I'm going to tell you right now, there's no way in heck, and I'll choose my words wisely here, that they're going to have significant rate cuts absent economic turmoil. The bullish narrative is they're just, come March, they're going to start cutting rates because they've reached their 2% inflation target. Well, the thing is, Ben, is if the economy is great, it will thrive with high interest rates. The
Hmm.
reason why we have a bad economy is because of the low interest rates. We needed to stimulate the economy. And so if there's no need to stimulate the economy, the Federal Reserve is not stupid. They know if they just slash rates right now, absent an economic tragedy or credit tightening or some type of an event, we're going to have inflation. You know,
Hmm.
so inflation will go up. So they're in this position to where they're not stupid. And to tell you, as far as the rebound in prices, that was a result, in my opinion, of many things. I'm just saying that the catalyst was the bank term funding program and changing the sentiment. But I mean, there's people on the sideline. There's always been people on the sideline, right? So you still have the people on the sideline. You still have excess savings as well. You have this obsession that America still has. So you change one thing and you change the sentiment and the mental attitude of people. I mean, you postpone a crash for another year. I mean, I'm convinced there's going to be some type of
Yeah.
crash event happening because of the data. But you know, it's hard to say what's going to happen with rates. I suspect rates will continue to go up into March, and I'm talking about mortgage rates, not the federal funds rate.
Mhm.
Because they know that the moment that they cut interest rates, people are going to flood back in that long end of the year. They're going to buy 10-year. Those rates are going to drop. That's going to drop mortgage rates. So even if Jerome drops the federal funds rate by 0.25%, that may drop mortgage rates by 1.5 points. Because remember, the federal funds
Mm.
rate is not directly attached to mortgage rates. A lot of what
Yes.
we're seeing in the mortgage rates is a result of the buying and selling of the 10-year treasury. So I think, though, that I think we're going to remain elevated, but I suspect sometime this year we're going to have those cracks start to unravel and rates will go down. I don't think we're going to have lower rates again unless we have unemployment, unless we have some type of catastrophe happen. I suspect that will happen probably towards the end of this year. If we weren't in an election year, I think it would be different.
Mm.
But being that we are in an election year, I think that it's possible that they kind of kick the can down the road, but I don't think it's going to be like last year. I think it's going to be a lot clearer to see through the cracks this year. But I suspect if we have significant rate cuts, it will be either third or fourth quarter of this year. I don't see them cutting first or second quarter unless a black swan, absent a black swan. I just don't see how it's possible.
Oh, no six rate cuts anymore. We're off the six rate cut narrative
I never
already.
said,
That's no, I
I,
know you didn't. That's but that was the prevailing narrative out there. And look how quickly it's changed. And you kind
oh,
of hit the nail on the head when you said the sentiment. And that's kind of what I focused on here. I focus on here a lot is the sentiment because that really, I mean, you encapsulated it perfectly. That really determines. It's almost like reality doesn't matter, but whatever the sentiment is going to determine how things move along. And it's very interesting you said that the sentiment here in my area, what kind of flipping a little bit. What are you seeing out? And you're out in Houston. What are you seeing sentiment wise on the ground there? Like how do buyers feel? How do sellers feel?
well, you have a tale of two tales. You have realtors that's saying that everything is great. You better buy right now. Oh my God, right? Then you have investors that are like, this numbers don't work. I don't have a
Mm.
cap rate here. So you got this varying thing. But I will tell you that being traveling around the nation, I've traveled through many different metro areas around the US. The sentiment is first of all, if you're a local, it's absolute garbage. You're already feeling a recession. You're already feeling it at the gas pumps, the grocery store. You've already spent all of your money. So for the natives, they're like, this is BS, man. But for
Yeah.
the people that are moving out of California and New York to come to Texas, they're like, this is the best thing I've ever seen in my life. I don't
Yeah.
care. I don't care that this is overpriced. My payment's $2,000 lower. The same house is a $500,000 lower here in Texas compared to California. So I don't care that it's overpriced because I'm saving so much money. And then you have on top of that, then you have the boomers and then the millennials. The boomers, the older generations are crushing it because they, first of all, understand fundamentals and have been investing. And now they are, I don't want to say filthy rich, but on average, they're a lot better off than millennials. Millennials right now, man, they are giving up. They're losing hope. They're saying, I'm not
Yeah.
going to be a homeowner. Who cares? Let me just charge debt. So you see all of this. And then look at the buyer's remorse surveys, man. I mean, you and I don't have to use our emotions. We don't have to, just look at the surveys. Look at the people that have recently purchased some of these surveys. And obviously these are like 1,000 people, 2,000 people. It's not the entire nation, obviously, but the buyer's remorse is in the 90%.
Yeah.
90%.
Yeah.
Imagine that for a second. Everyone's so worried about, I have to own a house to fit the American dream of homeownership, right? They're just so obsessed. And I see this happen all the time as an agent. Once someone begins the process, Ben, it's like you can't stop them. They're like a locomotive, 10,000 ton locomotive just going down the tracks. You can't stop it. Once it's in their head, once the sentiment is there that I'm going to get a house no matter what, then they don't care about bidding wars. They don't care about appraisal gaps. They don't care about the future. They don't care about wedge. They don't care about cash flow. They just, in their minds, need to get a house no matter what. And that's why I've taken a huge step out of real estate. I can't see it anymore. I'll tell someone like, this is what you need to look for, cash flow, wedge. As soon as we take them out, none of that matters. It's the granite countertops. It's the stainless steel appliances. It's the lighting in the house. It's like, okay, guys, I get that. But understand, like, if you own and you buy right now, you better love that house because that's all you're going to get. You're not going to get your cash flow. You're not going to get your wedge on average. If you were very careful, you might. But you got to love the house because there's no other benefit to owning right now overall.
Yeah, and it's tough. And like you said, it's very hard to educate on the hidden cost of home ownership. A lot of people don't consider that. It's so funny you said granite countertops, man, because when I'll take people out, well, there's a lot of flips in the area, and they're, in my opinion, very poorly done. But if it has a granite countertop, it doesn't matter that the ceiling tape's coming apart or the tiles are all mismatched and things are falling apart around the house. It's just like, oh, look at the nice granite. And they tend to see that without looking at the structural aspect. So you hit that right on the head. Once they're buy it for looks is almost, unfortunately, how most people go into purchasing the largest investment of their life.
Yeah. And Ben, it's always been like that.
Yeah.
So that's nothing new. It's just the problem right now. I mean, it's your primary residence. I get it. Maybe most people, they just want a roof over their head. They just want to raise their family. So I understand it. But the problem is right now is like the PE ratio is, depending on the metro, it's 7 times your income. That's the highest it's ever been. The unaffordability is of the 1980s. So we have unaffordability in the 1980s. We have an asset bubble worse than GFC. And people are buying based on emotions, based on desire. And honestly, right now, I just think that is such a very risky, even toxic move to make. Now, some people PE ratio, they're 1 because they're making a ton of money. Some people's payment to income ratio is 10% because they're making a ton of money. So be it. So buy, you're better off. But I'm talking normal consumers that are working over 40 hours a week. They're struggling to make their payments. They're in credit card debt. They're living paycheck to paycheck. I mean, those are the people that, to be honest, are really in control here. I mean, the economy is built on 70% of consumer spending, GDP anyway. So, it's an ugly situation, man. But the emotional buying is what helped create this problem.
Yeah, the FOMO, the jumping in. We've all got to get a piece of it, and the price to income ratio. It's you're so right. Typically it's been 3 to 4 times your income. Historically, to purchase a house, obviously higher than that in the GFC. But when we have homes here in my area, Southwest Florida, Charlotte County, I think the average sales price was north of $436,000 for December, and the median individual income in this county is like 30 grand. Household, that you might bump that to 65,000. Household, that's pre-tax again, not your health benefits, nothing else in there. It's so out of whack, and it's so tough, like you mentioned previously, for the locals here, and I'd assume, like you're saying, everywhere around the country. So it's yes, it's really tough. what I wanted to jump into too, since you having the mortgage background, what I get from a lot of people in the industry is, oh, we have surging demand. We have so many buyers jumping in right now, even though I believe rates are headed back over 7 here shortly, which tends to kill our market. Um, you know, is there, and I don't think there's any truth to it. To you, what do you see with the mortgage demand? Is, we keep hearing all these, they're touting all these huge numbers, but where is it really there?
The thing is, man, is like we're at historical lows to begin with. So any small blip is going to be bullish celebration, foolish optimism. And, first of all, I want to say that I do notice that when the media and the market's like, oh, okay, rates are going to go down, go buy right now. I see that affect my market almost immediately. But the
Yes.
thing is that's immediately wind down because we know they're not going to cut rates anymore. So overall, man, it's in the absolute gutter. If you look at, I just went over a report from Redfin. You can go to Redfin News. You can check this out. Mortgage demand is 20% lower year over year.
Mm.
Okay. The sales ended last year, the end of December, worst housing market from a sales and transaction standpoint since 1995. Mortgage demand lower than GFC levels, also in the 1990s. So, from literally, brother, any data point except mainstream media narrative, not only is buying demand not come back, it has continued to get crushed, and it has been the lowest it's been, again, from any data point in the last 4 years. So we're at a low right now of it was probably over a 4-year low, but that's as much as the data goes to that I review. Demand is in the absolute trash, but what you see is you see people saying things because they're desperate, and the reason they're desperate is they've lost the market share. They've lost the ability to profit. And so because a lot of these mortgage companies specifically are so top heavy when it comes to expenses, these people, I've seen companies go out of business already. In fact, the company that I stepped down for, that I was working for 10 years, Ben, that got through the GFC, they just got absorbed. They just went out of
Mm.
business. I can't, but literally 2 months after I stepped down, everyone got an email like, hey, we're, as of this day, we're not going to be in business. We're not AMCAP anymore.
Wow.
So we see it there.
Yeah.
You're going to get realtors being realtors, and quite frankly, overall, man, I mean, I'm ashamed to call myself a realtor because literally most people I'm seeing is again just that reckless cheerleading. You see it on social media. I see it on my friends on Facebook. It's so cringy because no one's talking about yield curve inversion, payments to income ratio, equity run up, PE ratio. No one's talking about these things. No, they don't even know what quantitative tightening is, Ben. So it's just a disgrace, brother. But the demand is absolutely in a dumpster fire right now, and it's even way lower than what it was this time last year. And remember where we were at last year. This time last year, everyone was freaking out, Ben. Remember,
Oh yeah.
this time last year, we were right in the front of the bank runs. And it was like the value was going down. We had Case Shiller coming out. We had deflation. Everyone was freaked out. Demand is now lower than that by up to
Mm.
20%. So.
Yeah, it's crazy, and I get it. I when you come out and we say things like this, or we highlight obvious inconsistencies in the narrative. In some way, indirectly, am I taking food out of somebody's mouth? Maybe, but I think it's just not beneficial to the entire profession with the reputation we currently have to continue to date the rates, marry the house, everything's going to be fine. Just I can't get over the amount of people that have assured people, flat
Yeah.
out guaranteed them that they can do something like that in the near future. So I always appreciate the accountability and transparency from you. But yeah, the demand here is, we're nowhere near where we were in the peak, which is also causing our listings to skyrocket because people just aren't coming to get them. We are pretty stable for like 2018, 2019 numbers of sales, but the people are listing like it's the frenzy. And if you guys have seen some of my other stuff, you've seen some of my stuff. The price decreases here are mind blowing. I'm talking $150,000 off some homes under 500 grand, starting out at 515, selling at 375. And most of the people will argue with me, well, they're just really crazy asking prices potentially, but we weren't seeing, that's kind of stuff's not getting told to anybody. Nobody knows these kind of things. And when we report, what's the list price to close price ratio, how much of their asking price did they get? They only count, in my area at least, the final asking price. They don't tell you, oh, they got 98% of ask, but they dropped the house $100,000 first. So there's all these conflicting narratives coming in. And we definitely need more people like you, kind of just shedding the light on that.
Yeah, I mean, I'm going to tell you right now, Ben. I mean, when it comes to the data for new home sales, it's an absolute disgrace. And what they're doing is criminal right now. There is a lack of transparency and accountability and consumer protections when it comes to new homes. They're not even required to report the data. They're still using surveys, brother. The census, they're still using how much inventory you have? We have 5 houses. Are you freaking? This is 2024. How are we using surveys? And it says on the Census Bureau that you're going to get about 78% of response. It's going to say it's financially biased. It says it on the freaking report. So I'm going to tell you right now, the situation with new homes on a nationwide average, at least, is it's a mind-blowing mess right now. It's just as bad as it was, not quite, but we don't know because of the data, as the GFC. They're not only not reporting enough inventory, and I know this because I have boots on the ground. I go into there, so I access MLS, multiple listing service, and census data, and new home source, so all 3. And I'm like, you guys, there's 2 times more inventory in this. 3 times more inventory in this. But the other thing that they're manipulating right now, they're manipulating the prices of existing homes because they're not giving us the true value that they're selling these homes for. One of the things that is very important, and this is my loan officer career, I see this all the time, you are supposed to remove seller concessions from the appraisal value. There's a section on the appraisal, I think it's the 6th row down, that says seller's concessions. It's on the appraisal. But the thing is the new home builders, a lot of them are not reporting the buy downs. They're not reporting the fixed rates. And some of the fixed rates that I see here in Texas, 4.5% fixed rate, brother. 30-year fixed, 4.5%. That costs $20,000, $30,000, $40,000. And they're not including that like they're supposed to in the appraisals. FHA just sent out a letter, said, hey, we found 1.8, I think it was like 1.8 or 1.6 million appraisals that were done incorrectly. You guys didn't even use the seller concessions. You have to take out the seller's concessions.
Wow.
They're not doing that. So on a nationwide average, new homes year over year are down 14%. Median is down 13.8%. But when we add those seller concessions that are not being reported, that are supposed to be reported, it's way worse than that. And here's the loophole. So Lennar sells a house. They're the builder. But guess what? They also own the mortgage company is it called Lennar Builder? No, it's called Lennar Mortgage. And because the incentives are now coming from Lennar Mortgage, which is BS, and not Lennar, which again is BS, therefore the seller is not giving concessions. But I know that Lennar is the seller and Lennar owns Lennar Mortgage. So all they're doing, brother, they're keeping stuff propped up for even longer. And in my opinion, they're violating law, and not just, they're violating like multiple laws, one of them being QM mortgages, qualified mortgages, as was created through the Dodd-Frank Wall Street Reform and Consumer Protection Act. You got to follow the law. If you're going to sell, like Lennar Mortgage, if they're going to sell to Fannie Mae and Freddie Mac or any other lender, they have to make sure that they're doing the proper appraisals. That's one requirement. So I suspect hell is coming for these new home builders. I actually did a video. I believe by 2026, we're going to see new home builders summons to Congress. And Congress is going to ask, what the F? Like, not only did you blindside us with the data and the hyper supply, you guys weren't even including seller concessions when you knew the whole time that you should, especially if the lender is giving them that. So the lender knows then there's a seller concession, because remember, it's Lennar Mortgage giving them that. So there's a loophole, man. It's quite frankly, it just all goes back into the lack of consumer protection. I mean, I don't understand. When we do existing sales, obviously we put seller concessions in the appraisal. They always ask. The appraiser asks for the purchase contract. They review the purchase contract to see, are there seller's concessions? They don't do that with new home building. It's a clown show.
Yeah, it's wild, man. Just to see everything that's going on behind the scenes, and that's very interesting that you would theorize that they could be in front of Congress shortly. I mean, that's kind of a very real scenario, especially with all of that going on, and the appraisal standards, they usually don't mess around. So we'll have to keep an eye on that for sure. Since you mentioned the Congress aspect, I want to pivot over to I had a commenter write in and ask me about this. Wanted to get your thoughts on it. There have been some calls in Congress and the Senate, in the government, to end the conservatorship for Fannie Mae and Freddie Mac that they were put into after the GFC, saying that they've basically grown up and now they can go back on their own again. And the commenter had asked, what was my thoughts on that? My initial thoughts would be it's going to just crush first time home buyers in the short term. I mean, I think things would get super strict. I know they've been a little lax, but I wanted to get your input on the probability, or even something like, what would you think that would, any impact you would see that having?
Well, first of all, Fannie Mae and Freddie Mac are the real banks. Okay, let's be honest. They control
Mm-hmm.
things. To me, even if so basically the government is running the show. So they're running the show per se because of conservatorship of Fannie Mae and Freddie Mac. So if they remove, first of all, they should have been removed because we've had over a decade past the GFC. So how the heck are they even in conservatorship anyways? They're making a killer amount of money. But I can see that in situations that they would tighten up lending standards so long as they didn't buy mortgage-backed securities. And that's really the other piece of the pie here. So you have the conservatorship ending potentially, okay, whatever. But the thing that needs to happen, in my opinion, the most, Ben, no more buying mortgage-backed securities. By the Fed, and that's what quantitative easing is. Okay, so we've got quantitative tightening, got quantitative easing. Quantitative easing is basically the Federal Reserve buying mortgages from lenders, because what lender is going to want to lend at 2% when we had 2%? No one is going to want to lend on that, so they lend on the short term. They make the profit on the origination and they sell it to the Fed, or they sell it to another company based on mortgage-backed security. So if the Fed has, I think, $2.4 trillion right now in mortgage-backed securities, and that's the real crime here, in my opinion. So I think we're putting the cart before the horse here on this one. I think what we need to do, no more mortgage-backed security purchasing from the Federal Reserve. If that happens, I think that the lending market and niche is going to be a lot more humbled. But again, when you have the Fed that's just going to bail you out, they're just going to buy these low interest rate mortgages. Why the hell do you care? If you're a banker, why care about safety? Why care about risk when your little brother controls the world? So MBS needs to stop.
Yeah, I'm with you on that one, brother. It's just been such a wild ride. 2023, as we were all in it. It was nuts. It was all over the place. I think we're getting a clearer picture of where things are headed now. But while I had you here, I wanted to see if you had any predictions or you had any insights, where you think, I guess, nationally and also in your local Houston market, where you see, 2024 going, if you can elaborate at all.
Well, 2024 is going to be hard. I'm worried about the presidential election, even though the GFC started during an election. Think about it. So when it's out of control, it's out of control. But nevertheless, what I've seen over the last election, man, it scares me to death. What they're willing to do to stay in power or to get power, I hate it. I don't trust any of them. I think it's a lesser two evil thing. But I think that what's going to happen this year, you're going to have spurts of buying in some metros. You're going to have home values go up in some metros. But the moment that things break apart, I mean, everything changes. Now, the question is will there be economic turmoil and recession in 2024? The odds say probably not. It's an election. But when we go back to the GFC, they couldn't stop it. So the thing is, though, when we compare GFC to right now, we have way more money in the system right now than the GFC. We have a stronger labor market than the GFC. Well, but remember, the GFC is when we already entered recession. So we can't really compare recession when we're not even in one, technically, even though I would argue that there are some places that are in recession. So I think that what we're going to see this year in 2024 is a housing market from a price standpoint, talking about existing homes. I think you're going to see same as last year, maybe not as much growth. Growth average last year was about 4%. I think it's going to be flat probably for the entire year, unless that black swan event happens. But I do think that 2024 is going to be easier to see through the cracks and to see what's really happening, right? Because we've been in quantitative tightening for even longer. We've been in it for 2 years, by the way. And I think that things really get bad in 2025. I don't think the politicians or leaders give a crap about 2025 because, again, they just got through the election.
Mm.
So whoever's elected is going to be going into economy that is crashing. But I really think that 2025 is going to be the worst time. I think that unemployment is going to be the highest then, and also 2025 is when we have the highest amount of forced commercial debt refinancing. And I think as a result of the
Mm.
higher expenses for these commercial loans to get refinanced, it's going to be higher expenses. And when things get higher expense wise, they got to cut labor costs. So I think we're going to see unemployment spike, not necessarily this year. I think it will go up this year, but I think it's going to be worse in 2025. Now, after that, 2026, I expect 2026 is going to be a bunch of bailing out as well. Maybe home builders. It's really hard to gauge because we also don't know who's going to be elected. So a lot of uncertainty, but I think that this year is going to continue to break. We may not see deflation on a nationwide average because again, there's still money in the system, and there's just so many people that want to buy. Unless that sentiment changes, if people understand the risk involved, the more and more that society understand the risk PE ratio, the lack of ability to sell or refinance, being trapped in your house upside down, then they're not going to buy. But if people think that there's no risk in purchasing, there's still going to be a handful of people that can afford these prices. But again, man, I mean, that's just to me, I think it's a kick the can down the road, keep it propped up for as long as possible, quite frankly. But I definitely think that is going to fall apart on average, and a lot of people are going to get hurt that are not prepared.
Mm. Yeah, so kind of status quo for 2024, and it's interesting, with the election that really, I guess, really at this point in time, no matter who we get, it's almost like a lame duck session. They can't come back, either one of them. It's because I'm assuming it's probably going to be Biden and Trump again, and it's their last term either way. So that's an interesting wrinkle to all of it there as well. But yeah, I I'd like to see something happen, but I'm kind of in the mindset with you too that it's probably going to be status quo for the year, and people just got to keep their head on a swivel and keep their eyes open and make the best decisions they can for themselves.
Yeah.
So
Yeah. And I would
yeah,
say also, man, I mean, use the data to find the deal. I can find in my own local housing market because I have access to MLS and I know how to find wedge and cash flow like really quickly. I could find deals right now. Right now, I could find
yeah,
houses under 2021 values and the seller pay all my closing costs under 2021 values right now. The problem is it's rare and it's spread out. So usually in order to find a great deal right now, you have to settle on a house that maybe you don't want. So I would say, yes, stay on a swivel, but if you have to buy for some reason, make sure you're buying with fundamentals, not emotion, which is asking a
absolutely.
lot.
Well, and it's not just us that has this data. Every agent has this data. Every agent can do this for you guys. It takes at best an afternoon, but I mean that's the kind of stuff people should be doing for you if they're working to earn your business. So if you have questions, ask your local experts. Everybody's got the info we have. We're not some secret gatekeepers who can only see this. This is basically pretty standard for most agents to get in now. Their geographic locations are going to be limited. Like I can't pull stuff
Yeah.
right now in Naples, things like that. But yeah, that's probably what I would say is just make sure you're informed. And well, yeah, Travis, at that point, I think we're going to probably call it a day here. And I appreciate everything you have brought to this conversation. It has been absolutely awesome talking with you guys. If you want, we're going to have a link to Travis's channel right below. If you somehow don't know who he is, absolutely check him out. He is just killing it over there and keeping it straight and honest. And that's what we look for here. So, Travis, thank you again for stopping by, and I hope we do it again sometime.
I hope so, brother. Thank you for an opportunity to speak to your viewers. Keep on doing you, man. I love how conservative you are, and it's been an honor to talk with you today.